Well, I have the pleasure of introducing to you today Stephen Schwarzman, who has kindly agreed to lecture our class. Mr. Schwarzman graduated from Yale in 1969. He was at Davenport College. Do we have any Davenport people here? Any? A few, not a lot. He graduated then from Harvard Business School in 1972. He worked at Lehman Brothers as, I don't know if it was his first job or one of his first jobs, and became managing director at Lehman Brothers at age 31. And he became head of their global mergers and acquisitions team. In 1985, Mr. Schwarzman, with Peter Peterson, founded the Blackstone Group, which has become the lead manager of alternative assets. In some sense, what he does and what David Swensen does, whom we had heard from earlier this semester, is similar. They're both looking at unusual and different investment assets. And they are both very successful in doing this. Mr. Schwarzman's firm has had a return on private equity investments of 23% a year on average for the last 20 years. This is a little bit in excess of David Swensen, but I think we have to put them both as remarkable investors. In the real estate group at Blackstone, they've had 30% a year for the last 15 years. And this is after fees. Blackstone Group has been very much in the news recently. It just came out that they are apparently going to be buying $12.5 billion of leveraged loans from Citigroup at a steep discount. And so apparently they've seen a profit opportunity there, or they're supporting our economy from the ravages of the subprime crisis. Also in the news, China has announced that it plans to buy $3 billion stake in Blackstone Group as its first effort to diversify its $1.2 trillion of foreign exchange reserves. So the Blackstone Group was picked by the Chinese government as the most fitting place for it to put some of its reserves. So with that, I will leave it to Mr. Schwarzman, who will speak for a while.
Thank you very much for coming out on what's a bit of a dreary, slightly rainy morning. When I was in an undergraduate, we wouldn't have gotten much of an attendance. People would have been sleeping in. So it's awful nice of you to be here. There are some dramatic differences from when I was an undergraduate and you are. One of the first differences is that this course wouldn't have existed because no one had an interest in finance at that time. It wasn't a particularly interesting time in the 1960s. The securities markets actually were regulated. Commissions were fixed on the New York Stock Exchange, so it was very difficult to find some way to compete. It was sort of a rigged system, if you will, and it wasn't open, and so there was very little to no interest, really, in finance. There really wasn't an SOM, School of Management at Yale at that point. Business generally was utterly unfashionable. We were in the midst of the Vietnam War, and business was sort of linked to the perception of that war because they supplied, certain types of war materials, and that was the most unfashionable thing that you could be involved with. So there was a very anti-business, non-existent finance orientation at the school, and obviously that's changed in the society generally with enormous differences. And as a result of when I grew up, I didn't even take an economics course at Yale. I frankly wasn't much good with math. I stopped in the 11th grade, and I think calculus was for me, that was way too much of a reach. So I'm more in the add, subtract, multiply, and divide kind of category, which worked and still does, quite well for me. And when I graduated, I was lucky enough to get a job at a firm that had just gone public. It was the first New York Stock Exchange firm that had just gone public. It was called Donaldson, Lufkin and Jenrette. And Bill Donaldson actually founded the School of Management after he left DLJ, and that was, because this is a financial markets course, that was quite interesting for me, because I didn't even know what common stock was when I graduated. Hopefully you will have learned more in this course. And I went to DLJ. I couldn't read a financial statement, which is like going to a foreign country and not being able to speak a language. It was sort of hopeless. But one of the interesting experiences I had about which really, now that I'm a little bit older and can look backwards on financial markets, it was my first visit to a company. And DLJ basically was one of the first large institutional stock managers of pension fund assets and so forth. And I was allowed to go and interview a company. I'd never interviewed a company executive, and I read, their annual report, and I went up to see this gentleman, and I sat there and I figured out all the things I'd want to know so that I could figure out whether I should buy his stock or invest in his company. And I went through my list of questions, and he wouldn't answer most of them. And I found it a very frustrating experience. And I went back to the office, and by the time I got back to the office, Dick Jenrette, who was president of the firm, had gotten an enraged phone call from this executive, and called me into his office, and he said, "Geez, you made this man very angry." I said, "Well, how could I do that? I was just asking questions." And he wasn't answering them, so I just asked the question again. I couldn't quite understand why he wasn't answering me. He said, "Well, you were asking him things that he's not allowed to answer." I said, "What do you mean?" He said, "Well, you were asking him for inside information." I said, "Well, I don't know what inside information is. I'm just asking the question that I need to know the answer whether to buy the stock or not." And he said, "Well, Steve, there are all these rules of what you can ask somebody, and then if he tells you, then he has to tell everybody in the world, and that's just too cumbersome, and so that's why he didn't answer." I said, "Well, if he didn't answer, how in the world can you figure out what to do?" And I said, I'm not that smart. I need to have all relevant data. And he's the person who has it, so why won't he give it to me? And it became pretty clear that I was doing the wrong thing for a living. And in effect, that's the dilemma for people who want to buy liquid securities. And I decided very quickly this was a bad business, certainly a bad one for me, that I couldn't figure out how I could win that game, when somebody wouldn't fully share openly everything they knew. And I guess if you were like a sumo with a good fashion sense, that's how you manage liquid securities and beat other people. It's not just what you know, it's a question of whether the rest of the world will buy into what you know and drive that security up. And so I basically retreated and went to Harvard Business School, where I figured maybe somebody will tell me how this game really works in a way that I can prosper in it. And that was a good experience for me. they basically taught you, and you're undergraduates, so you don't know what they're teaching you at a school like that, so I can explain it actually pretty clearly. It's basically they're teaching you that everything you do with a company has something else to do with that company, so that it's an integrated system. So that if you are trying to develop a product for sale, it would be good to know whether somebody wants it, right? So what happens actually in the real world is that sometimes people just get an interesting idea and they'll produce a product and nobody will want it. And if you integrate all the different kinds of knowledge in the company so that you're doing intelligent things, and I know this appears very elementary, you'll have a better company. That's sort of what they were teaching. And after they taught that for like 2 or 3 months, I sort of got it and thought about dropping out of school because it got a little repetitive, frankly. But I was convinced by my friend Dick Jenneret, who also thought about dropping out of Harvard Business School. In December, it gets very cold in Boston and really miserable. And he was going to drop out and go and get a PhD in economics. I was going to drop out and go back to the real world. And he said that his staying on was a good thing and I should stay on. And so I did. And what I've sort of done for a career is try and solve that problem of my initial meeting, where people will... I want people to tell me what's really going on so I can figure out, whether what they're saying makes sense or doesn't make sense. And you can do that in the private equity business, which was sort of our largest business. And you could do that in the real estate business because you're allowed to get all that inside information if you're trying to buy a company with our rules and also the rules of other countries. If you sign a confidentiality agreement that you won't use that information for any purpose other than buying the company and putting a price on it, and then the shareholders get a chance to vote on whether they want the price that you give them. So to me that was like an answer to my conundrum of how could we get all the information and then figure out what to do with it, including improving the company. I'm sure you know something about private equity. If you read the general newspapers, I'll tell you basically what it is. Well, all we do is we buy companies, and that's the simplest thing we do. We do a lot of other things, but let's start with we buy companies. We borrow money to buy those companies. Historically, it's been about $3 of debt for every $1 of equity. We then improve those companies, through a whole variety of, sort of managerial actions, and then those companies grow with the general economy. And let's say if they just grow at the regular rate of all companies, then if you're leveraged 3 to 1, you're going to earn a much better return. If you take a company and can accelerate its growth, so it's growing faster because you've improved it and you have 3 to 1 leverage, you'll get a way better return than any normal stock market kind of return. And that's sort of the model of what we do in that business. As Professor Schiller was saying, we've compounded after fees at 23%, but before fees, because we charge a 20% part of the profits of the deal goes back to the general partner, which is us. We actually earned around 31%, which from you being in a course like this, you'd see that's really pretty high, compared to a stock market average over a period, which would be around 11. And in real estate, where we do the same kind of thing, but real estate is an easier business because buildings don't talk. Managements of companies talk, and you have to figure out what they're saying. Companies are very complex. You have interesting competition. You have global competition. It's a complicated asset class. Real estate is very simple. I mean, there's buildings don't talk, and so you can't get misled by a building. They can't tell you something. They don't have a belief system, and it's just there. It's on the corner. It's in the middle of the block, and there are other buildings that either are getting built or planned, and you can figure out what the supply-demand is for real estate in a much easier way, and because of that, our returns in real estate have been better because it's an easier asset class, and we've earned after fees 30% a year since we started, and before fees close to 40%. So this alternative asset class, if handled right, is really a much better way of earning money for investors, as well as the general partner, let's not forget us, than regular financial markets investing. And that world has been started very small. When we started it, the institutions had less than 1% of their assets. It was like infinitesimal in the private equity side of the business. It's now up to about 4.5%, and the returns are so much higher, you'd wonder why people don't give us all their money on an asset allocation basis, and I actually still wonder why they don't, since we put most of our money in that, and we keep making more and more and outperforming, and it just takes the rest of the world apparently the equivalent of your lifetime to sort of figure out exactly what they should be doing, and I think the projections are that this should be growing at a lot faster rate, going into the future, and some institutions like Yale have private equity with around, I guess it's around 16-17%. It was up to 18 of their portfolio, and that's one of the reasons why Dave Swenson has done much better than regular money managers. Turning to a different subject, it's a financial markets course, and I thought it would be useful to talk to you a little bit about what's really going on in the real world, even though this course is being recorded, and whatever you say about the current moment turns out to be right or wrong, but it's just a current moment. It's such a fascinating one, and you all are, I guess, somewhere between 18 and 21 years old, probably 19 and 21. So you don't have the perspective to understand how really interesting and dangerous this current environment is. What's happened is that through an abnormal issuance of something called subprime securities, for nobody in this audience, certainly people watching, have probably own a house. And what happened is that in the late 90s, the government in Washington passed a law to encourage more low-income people being able to buy houses, and resulted, along with other factors, in an explosion of these types of loans. And in terms of loans, and Professor Schiller can correct me if I'm slightly off on this, but in the year 2002, of the total mortgage loans that were originated for houses, probably around 2 to 3% of them were subprime. And these are for people who don't have enough money to really pay normal principal or interest and expect their mortgage to be current, to not go into default. And by 2006, this had exploded to 30% of all the mortgages that were issued that year. When you go from 2 to 3% to 30%, this is an almost out-of-body experience, and to entice these people to take these loans, they actually would tell somebody. In the olden days, when I was your age, to buy a house, you had to put up like 25% of the cost of the house. Sometimes you'd have to put up 20% of the cost of the house, and you can borrow 80. These subprime loans, sometimes you only had to put up 3% of the cost of the house. Sometimes you didn't even have to put up anything. That makes it really affordable. And then you didn't have to pay any interest for 2 or 3 years. So you put up nothing and you paid nothing. So this led to a stampede of people who wanted this. And what's happening now is that the mortgage, the interest, which no one, a lot of these mortgages didn't have to pay, now 2 to 3 years later you have to pay it. And a lot of the people who didn't have the resources can't pay the mortgages. Those mortgages are defaulting. The issue that created all the problems in the financial system that you're reading about in the front page is that these mortgages were pooled in a new security. Imagine just sort of a jar where somebody threw in a few thousand of these mortgages and then put the lid on it. So they had these new securities, and what they did is they said, well, the first 83% of them must be really safe because mortgages basically hardly ever default. And they rated those, the rating agencies, which tell people how secure something is, rated this as a AAA security. In the world of finance, when you tell somebody that a security is AAA, they get rated all the way from AAAs down to CCCs. And CCC means something's about to blow up. And AAA means there's no possible chance you're ever going to lose your money. And so because 83% of this jar was rated, AAA, people bought this all over the world as if it was a security that could never, ever, ever default. And as you can see, these were basically mortgages made to low-income people who weren't even paying, in some cases, interest on it. And the chance that these were going to default was really sky high. Historians will go back and figure out why anybody would believe that these things could be AAA. But they did, and they were bought everywhere. So these securities became like American SARS. They were exported throughout the world, creating enormous problems for individual institutions, around the world. And in the United States, they've created what will be hundreds of billions of dollars of losses for the financial institutions. And as part of Sarbanes-Oxley, which was a law passed after Enron and some other things, we've developed accounting procedures with something called, it's very technical, called FAS 157, which is called fair value accounting, which means before these defaults even happen, the fact that other people think they're going to happen results in the securities being worth less, and you have to take a loss based on that expected value. So the financial institutions were losing all this money without the defaults even happening or people knowing how bad it would be. And as a result of those large losses, the financial markets started losing confidence in some of the financial institutions, and different asset classes in those financial institutions, principally banks, started trading in a really bad way. People thought they were going to, be forced to sell some of those, and we had a variety of different asset classes ranging from municipal bonds, basically changing their value. People said, I don't want these anymore. There were hedge funds that owned those on leverage. So there were margin calls which forced those securities to be sold, which made them worth even less. That got the banks even more nervous. That resulted in higher rated securities being sold that were also on leverage. And what you had was like panic selling of securities rolling through every element of the financial system as people desperately tried to get out of stuff before it would become worth less. And this type of rapid deleveraging resulted in downward valuations for all these securities, a lot of hedge funds going bankrupt, anyone with leverage borrowing more than 5 to 1 to carry some very secure real securities, not subprime, but government-oriented securities. Those institutions got into trouble. And what we've had is basically a melt in the financial markets where the banks have been so severely impacted that they have stopped lending to certain whole asset classes, particularly leverage lending, which we're involved with, as well as other areas. The costs of credit have gone up, sort of 3%, 4%, which doesn't sound like much to you, but it actually in the overall system is a lot. And what that's resulted in is a financial crisis. It's resulted in the Federal Reserve, who's the ultimate protector of the system, very quickly lowering interest rates, agreeing to lend huge amounts of money to the banking system, because banks are now not even lending money to each other. They're sufficiently scared about what's going on. And the Federal Reserve is saying, well, everybody can come to me and I'll lend you all money to keep you liquid so this whole system doesn't stop. Now, as it impacts regular people, is when the financial institutions go into a crisis like this and stop lending or reduce their lending of money, there's less money for regular people to borrow to go about their lives, and businesses to get. And as that starts happening, an economy will slow down and go into recession, and that's what's happening in the United States.